Most traders don't lose money because of the market. They lose because they are fighting human nature. Today, I'm revealing the exact pivot point strategy that Jesse Livermore used to make $100 million while the rest of Wall Street was going bankrupt. But fair warning, if you don't understand the key I'm about to show you, your stop loss doesn't matter. Let's decode the greatest trader who ever lived. Most traders sit in front of charts looking for something to happen. They are not waiting for clarity. They are waiting for stimulation, a fast candle, a sudden breakout, a sharp rejection, anything that makes the screen feel alive. They call this reading the market, but it is not analysis. It is emotional engagement. Professionals do not engage with charts emotionally. They observe them structurally. Structure is not exciting. It does not move quickly. It does not announce itself. It builds quietly through time, repetition, and balance. It requires distance, not intensity. The professional trader understands this early or pays heavily until they do. Stimulation pulls the trader into the chart. Structure pushes the trader back from it. When a trader seeks stimulation, they shorten time frames, zoom in, add tools, and watch every tick. The nervous system becomes active. Heart rate increases. Focus narrows. Decisions are made faster, but not better. The trader feels involved, alert, and productive while discipline quietly erodes. This state is dangerous because it feels like work. The market is full of movement that means nothing. Small fluctuations driven by noise, emotion, and random order flow dominate most of the day. These movements are designed to provoke reaction, not reward skill. Traders who respond to them are not unlucky. They are unfiltered. Professionals filter relentlessly. They do not ask what the market is doing. They ask whether what it is doing matters. Structure answers that question. Structure defines where price has memory, where decisions were made before, where balance shifted, and where commitment is visible. It does not care about speed. It does not care about excitement. It only cares about relevance. Relevance is rare. Most traders never see it because they are too busy reacting. They mistake volatility for opportunity. They mistake movement for intention. They mistake urgency for importance. These mistakes compound until the trader no longer trusts themselves. Stimulation creates addiction. The trader becomes dependent on action. Waiting feels uncomfortable. Silence feels unproductive. Boredom feels like failure. The mind looks for reasons to act because action provides relief, not profit. Relief from uncertainty. Relief from boredom. Relief from self-doubt. Trading becomes a way to regulate emotion rather than manage risk. Professionals recognize this trap because they have fallen into it before. They learned through pain that reacting to stimulation produces inconsistent results and emotional exhaustion. They learned that the chart is not there to entertain them. It is there to test their restraint. Restraint is not passive. It is deliberate resistance. Resistance against the urge to interfere. Resistance against the belief that every movement requires a response. Resistance against the voice that says you are missing out. That voice is not intuition. It is insecurity. The professional trader builds distance from the chart. They step back mentally and physically. They limit screen time. They simplify visuals. They remove indicators that trigger emotion without adding clarity. Every reduction is intentional. Less stimulation, more structure. This is why professional charts often look empty to beginners. Fewer lines, fewer signals, more space. That space is not ignorance. It is control. It allows the trader to see context instead of noise. Context takes time to form. Structure emerges when price behaves consistently around certain levels, when reactions repeat, when momentum aligns across time. This cannot be seen by staring harder. It is seen by waiting longer. Waiting is painful for the undisciplined mind. The mind wants feedback. It wants confirmation. It wants to feel useful. When nothing happens, it invents meaning. It labels random movement as signal. It creates stories to justify action. Professionals do not argue with these thoughts. They do not follow them either. They understand that clarity does not come from thinking harder. It comes from allowing the market to reveal itself. That revelation cannot be rushed. The trader must be still enough to see it. Stillness feels like weakness to the amateur. It feels like strength to the amateur. It feels like strength to the professional, because the professional knows what happens when stillness is absent. Overtrading, chasing, emotional entries, moving stops, revenge trades, small losses stacking into large ones, confidence collapsing. All of it begins with stimulation-seeking behavior. Structure protects against this. It limits decisions. It defines when action is allowed and when it is forbidden. Without structure, every moment becomes a decision point. Too many decisions exhaust discipline. Exhausted discipline leads to mistakes. Professionals conserve discipline like capital. They know mental energy is finite. Every unnecessary decision spends it. Every impulsive reaction drains it. By focusing on structure, they reduce the number of decisions they must make. Fewer decisions mean higher quality execution when it matters. This is why professionals appear calm, not because they are fearless, but because they are protected. Protected by rules, protected by context, protected by structure. They do not need to watch every candle because they know most candles are irrelevant. They do not need to be early because being early carries risk without confirmation. They do not need to be involved constantly because survival does not require participation. The amateur trader reads charts hoping the market will cooperate. The professional reads charts knowing the market owes them nothing. That acceptance changes how the chart is seen. There is no argument with price, no frustration when nothing happens, no excitement when something does. Just observation. Observation without attachment. When a trade fails, the professional does not blame the chart. They examine whether structure was present and whether rules were followed. If both were respected, the loss is accepted without emotional damage. If not, the error is internal. Honesty is brutal and necessary. Structure removes excuses. It does not allow the trader to blame speed, noise, or manipulation. It forces responsibility back onto behavior. That responsibility is heavy, but it is the foundation of consistency. Most traders never learn to see structure because stimulation keeps them busy. Busy feels safe. Busy feels productive. Busy feels like progress, but busy traders are often the least disciplined. Professionals are comfortable doing nothing. They are comfortable watching price move without reacting. They are comfortable missing trades. They are comfortable being bored. These comforters are not natural. They are earned through pain and repetition. The trader who learns to see structure stops trying to outsmart the market. They stop forcing outcomes. They stop treating charts like puzzles to be solved quickly. They let time do the work, and time always reveals what stimulation hides. The market is not the enemy. It is neutral. The enemy is the trader's need for stimulation. When that need is brought under control, charts become simpler, decisions become fewer, execution becomes cleaner, and trading finally becomes what it was always meant to be, a discipline of restraint, not a game of reaction. The market moves constantly, but meaning does not. This is the first truth professionals accept, and struggling traders resist. They look at a chart and assume movement equals opportunity. A candle moves, volume appears, price accelerates, and the mind reacts. It feels important. It feels urgent. It feels like something must be done. That feeling is the test. Most price movement exists without intention. It is the result of short-term emotion, random order flow, hedging, and noise created by participants who are not trading with direction in mind. This movement is not there to reward you. It is there to expose you. Noise does not attack your strategy. It attacks your patience. The impatient trader interprets noise as signal. They see small fluctuations and project meaning onto them. They enter early, exit late, and justify decisions with hindsight. They are not reading the market. They are reacting to discomfort. Professionals understand that noise is unavoidable. The market cannot move from one meaningful area to another without creating chaos in between. That chaos is where most traders lose discipline. It feels uncomfortable to watch price move without clarity. The mind wants resolution. It wants certainty. It wants to feel useful. Noise feeds that weakness. This is why patience is not passive in trading. It is active resistance against the urge to participate in meaningless movement. Resistance against the belief that missing action equals missing opportunity. The professional trader does not fear noise. They expect it. They know that real opportunity reveals itself slowly, not suddenly. It develops through structure, context, and time. Noise fades when intention appears. Until then, the correct action is inaction. This is where most traders fail. They believe patience means waiting for price to move in their favor. That is not patience. Patience means waiting without emotional involvement. It means allowing price to fluctuate without interpreting every move as a message. Noise tests discipline because it feels endless. It creates boredom, frustration, and doubt. It tempts the trader to break rules just to feel engaged. Many losses are taken not because a setup failed, but because patience ran out. The market did not force that entry. The trader surrendered to impatience. Professionals train themselves to see noise as protection. Noise keeps them out of bad trades. It filters out emotional decisions. It prevents unnecessary risk. When the market is noisy, professionals conserve capital and mental energy. This conservation is strategic. Mental fatigue is one of the most underestimated risks in trading. Each unnecessary trade drains focus. Each emotional reaction weakens control. Noise increases decision-making pressure, and pressure breaks discipline. By accepting that most movement is meaningless, professionals reduce the number of decisions they must make. Fewer decisions mean higher quality execution. When real opportunity appears, patience is not rewarded immediately. That is why it is rare. The trader who learns to endure noise without acting gains a powerful advantage. They stop fighting the market. They stop fighting themselves. They wait until movement has purpose, until structure confirms, until risk is justified. The market does not punish impatience loudly. It drains it quietly, and only those who learn to sit through noise without interference ever reach consistent results. Charts do not lie, but they become useless the moment emotion takes control. Most traders believe they are reading price when in reality they are reading their own feelings projected onto the screen. Fear sharpens every red candle. Hope exaggerates every green one. Urgency compresses time. Boredom invents meaning where none exists. The chart itself remains neutral, but the interpretation becomes distorted. This is where chart reading breaks down. Context is slow. Emotion is fast. Context requires patience, distance, and restraint. Emotion demands immediate response. When emotion enters he process, the trader, stops seeing the market as it is and starts seeing it as they need it to be. They want confirmation, so they see it. They fear loss, so they see danger. They crave action, so they see opportunity. None of this comes from the chart. Context answers essential questions. Where is price relative to prior decisions? Has time confirmed direction? Is the market balanced or committed? Is this movement meaningful, or is it noise? These questions cannot be answered emotionally. They require objectivity. Emotion bypasses these questions entirely. An emotional trader zooms in instead of stepping back. They shorten time frames to escape uncertainty. They add indicators to reduce discomfort. Each addition increases confusion. Each reaction pulls them further away from context. This is why traders say the market is confusing. It isn't. Their mind is. When emotion replaces context, every candle becomes a threat or a promise. The trader becomes reactive. They enter during formation instead of completion. They exit because of fear, not structure. They move stops to avoid pain. They override plans to chase relief. At that point, the chart is no longer a tool. It is a trigger. Professionals protect context aggressively. They do not allow emotional states to dictate interpretation. They understand that feelings are information about the trader, not the market. If fear appears, it signals uncertainty. If excitement appears, it signals temptation. Neither is a reason to trade. They step back. Distance restores context. It allows the trader to see how small the current movement is within the larger structure. It reminds them that time matters more than ticks. It reminds them that time matters more than ticks. It reduces urgency and restores clarity. Context also protects discipline. When a trader knows where price is within the larger picture, they are less likely to force entries. They understand that even strong moves mean nothing if they occur in the wrong place or at the wrong time. Emotion ignores place and time. Context depends on both. This is why professionals often appear calm when others panic. They are not detached from risk. They are anchored in context. Losses taken within context are tolerable. Losses taken emotionally are damaging. Emotional losses hurt because the trader knows the decision was compromised. Contextual losses are accepted because the process was respected. This difference determines whether confidence survives or collapses. Chart reading does not improve with sharper eyes. It improves with emotional control. Until emotion is contained, no amount of screen time will create clarity. The trader will continue to see what they feel instead of what exists, and the market will continue to punish that confusion without explanation. Context is not optional. It is the foundation. When emotion replaces it, chart reading becomes guesswork, dressed up as analysis, and consistency disappears. Charts do not become unclear on their own. They become unclear when the trader loses control of their internal state. Price is neutral. It moves because orders move. It has no intention toward you. No awareness of your position, no responsibility to confirm your bias. Yet most traders experience the chart as if it were personal. A candle forms and the body reacts. A level breaks and the heart rate changes. At that moment, chart reading stops being observation and becomes emotional interpretation. This is where failure begins. Context is the ability to see price in relation to time, structure, and prior behavior. Emotion collapses that perspective. It narrows focus. It compresses time. It turns a small movement into a threat or an opportunity depending on what the trader wants to feel in that moment. Fear magnifies danger. Hope magnifies promise. Urgency magnifies everything. None of these come from the chart. When emotion replaces context, traders stop asking the right questions. They no longer ask where price is within the larger structure. They stop considering whether a move has confirmation or whether it is occurring in the correct environment. Instead, they ask one dangerous question. What is happening right now? Right now is the most expensive time to think. The market is always doing something right now. If that were enough, everyone would be profitable. Context requires stepping back. It requires patience. It requires the discipline to let information develop instead of forcing meaning onto incomplete data. Emotion does the opposite. It demands immediate resolution. It wants certainty now. It wants relief from discomfort, and trading becomes a tool for emotional regulation rather than risk management. This is why emotional traders zoom in. Zooming in feels like control. It feels precise. It feels active. In reality, it removes context entirely. The smaller the window, the louder the noise. The louder the noise, the stronger the emotional reaction. The trader believes they are seeing more when they are actually seeing less. Professionals step out before they step in. They understand that context does not live in individual candles, it lives in behavior over time. They care about how price reacts, not how fast it moves. They care about where price has failed before, not where it is excited now. Emotion blinds traders to this. An emotional trader sees a breakout and feels excitement before asking whether it is supported. They see a pullback and feel fear before asking whether structure is intact. They exit because it feels wrong, not because context changed. They enter because it feels right, not because conditions aligned. These trades hurt more than others not because the loss is larger, but because the trader knows the decision was compromise. Insight. That knowledge damages confidence. It creates self-doubt. It leads to overcorrection, hesitation, or revenge behavior. This is how traders spiral. Professionals treat emotion as information about themselves, not the market. If anxiety appears, they question clarity. If excitement appears, they question temptation. If frustration appears, they question discipline. They do not obey these feelings. They investigate them. Investigation restores context. Context brings calm not because risk disappears, but because decisions are no longer reactive. The trader knows why they are in a trade, why they are not in a trade, and what invalidates the idea. There is no debate once execution begins. Emotion creates debate mid-trade. Context eliminates it before entry. This difference determines longevity. The market is designed to provoke emotion. Sharp moves trigger fear. Slow movement triggers impatience. Sideways price triggers boredom. Each state tempts the trader to interfere. Interference is the enemy of consistency. Professionals do not fight emotion directly. They limit its influence. They reduce screen time. They avoid watching price tick by tick. They use rules that define when interpretation is allowed and when it is forbidden. These rules are not technical tricks. They are psychological boundaries. Boundaries protect context. Without boundaries, every moment becomes a decision point. Too many decision points overwhelm discipline. The trader starts reacting instead of executing. Execution requires calm. Calm requires perspective. Perspective comes from context. When context is present, losses are survivable. A loss taken within context is understood. It was planned. It was accepted. It does not threaten identity. When context is absent, losses feel chaotic. They feel unfair. They feel personal. That is why emotional losses are harder to recover from than large ones. Emotional traders often believe they need more screen time to improve chart reading. The opposite is usually true. They need more distance, more space, more restraint. The chart does not reward intensity. It rewards patience. Patience allows context to form. Context reveals whether a move matters. It reveals whether time supports direction. It reveals whether risk is justified. None of this can be seen while emotionally attached to every fluctuation. Professionals are not immune to emotion. They are disciplined about not letting it lead. They accept that emotion will appear. They expect it. They plan for it. They build systems that function even when emotion is present. This is not emotional suppression. It is emotional containment. Containment is strength. When emotion replaces context, chart reading becomes guesswork, wrapped in confidence. The trader feels busy, involved, and intelligent until results expose the